Hello and welcome back to the ROI channel, the channel that's obsessed with the art and science of return on investment. And today, if you've been keeping an eye on Substack, you'll know there's been a new recent entry into the Substack sphere. It's got quite the reception. It's, of course, Josh Young of Bison Interest. My friend is joining me today. We're going to chat all things oil and gas. All the poor oil and gas investors out there have been thinking to themselves, we're sitting on a value opportunity and eventually the market will recognize it. Josh, what's it going to take for the market to recognize the value of oil and gas investments? In 2025, we're still not all driving Teslas. We're all driving ICE vehicles, right?
Yeah, pretty much. Supposedly in China, the majority of car sales there are electric vehicles, but then they also lie about all their other economic statistics. So TBD.
Yeah, it's a little bit hard to hang your hat on those stats. But I wanted to start off talking about the broad state of the market generally. In my eyes, things seem to be a little bit toppy, but then they always seem to be toppy, and then they get to the more toppy and the more toppy and the more toppy. Energy as a sector is less than 3% of the S&P 500. And you and I were talking a little bit off camera about all the top 7, 8, 9 stocks even in the S&P 500 are mainly driven by the AI narrative, which is really the database narrative. And so what I'm thinking is, how is this sort of $19 trillion worth of capital not going to start to rotate when the bottleneck for their development depends on the energy sector? How do you reconcile energy being less than 3% of the S&P?
Yeah, I mean, it's such a good question, and there's so much baked into that, right? So, first of all, I will say I was a data center, AI data center skeptic as I started seeing these things start to get built out and planned and so on. Increasingly, I observe who's involved in funding these and building them and contracting for them. And many of the wealthiest people in the world with track records that put every investment manager in the world to shame. Are the people writing these checks and approving these expenditures for their corporations that in some cases they personally founded. And so, I see the skepticism by the, Einhorns and, some of my close friends have been very public about the pessimism. And, I think I'm a lot more balanced on it in terms of, the market valuations. Who knows how much money these things will make? But I think it makes sense to give a little bit of grace to, the Mark Zuckerbergs and Larry Ellisons and so on of the world, who again have just been phenomenally successful, not just with their initial ideas, but then, their rollouts of companies and where they've allocated capital over the course, in some cases, of many decades. And then you see the big investment firms on the private side going and pushing increasing amounts of money on the private debt side and the real estate side on these data centers and so on, whether it's, Blackstone making an enormous bet on this. I just saw a headline, Ares is apparently raising another $8 billion to put into data centers. And so when I try to reconcile that with energy, it's important to validate the track records of the folks allocating. Again, I'm not going and buying data centers. I'm not saying I will or should, or my clients should, or anyone listening to this should, but it's helpful to think about that in terms of the likely demand for energy for these data centers, because these things in many cases are funded years out into the future in terms of, these construction projects and the chips that are getting bought. And the energy demand for the likely energy demand is growing astronomically, but people's skepticism around them is growing with the likely energy demand. And then the energy stocks, like you were saying, have really not kept pace at all. And so I think it's setting up for a pretty big sort of market reckoning and market catastrophe potentially. So yeah, I think there's a very, very big disconnect, and I think there's a lot of potential opportunity here.
And all the points that you made are really what I'm thinking. I don't pretend to know anything about AI and whether I think it's going to be a tough ask for these guys to really make a lot of money out of it. But who knows? As you said, there's a lot of smart people behind it. So they obviously feel differently that they are going to make money. All I know is that all of these things require these raw inputs, the land, the energy in order to power these things. And it's kind of a case of either humans give up on AI and crypto mining and data centers, and I don't think that's going to happen. I think that's a one-way street now. Or we need to channel those resources, and of course that's going to increase the demand for them. We've spoken about the index broadly, and I think a lot of people kind of get a misconception when they are judging the performance of certain investors or managers. And everyone seems to be judged against the S&P 500, even if what they do specifically doesn't necessarily correlate with that broad measure. And I understand why people use that. However, I don't think it's telling the whole story. So you, for instance, you're an active manager and you're in a niche business, the oil and gas investment sector. People comparing that to the broad S&P are kind of comparing that to the indiscriminatory buying of the algorithms of all the capital that's then mandated to just buy the S&P. So talk to me about how you view your performance as compared to the ETFs that are relevant to your particular sector.
Sure. Yeah. And just as a disclaimer, it's not my question. I will
Well,
answer you because I'm
I
allowed to.
I should have said that. I should have put the disclaimer. That's my
Yeah,
bad.
yeah. No, no, it's okay. And I'm not, this is, but I think it's a fair question and I'll try to answer it, but this isn't meant as an offer or solicitation, and all return data should be vetted separately and verified and so on. So yeah, I think like the first thing that comes to mind when you mention that are the, hedge fund returns that you see from the long short funds that have zero net exposure, like the Citadels and Millenniums and whatever, who are brilliant and have amazing track records. But people are like, oh, they're so stupid because they got a 3% return and the market's up 20% or whatever. But they're not comped on that. Their business isn't to beat the stock market. Their business is to beat other hedge funds and to try to beat the risk-free rate. Or, a bond fund, right? You look at a treasury bond fund or a corporate bond fund, their job is to beat their relevant index. And everyone knows sort of that the returns for those are going to be different and somewhat independent of the returns for the general stock market. So I think that's a similar idea for a sector fund, even in the public equity market. And so, we were talking about a little, and I've been thinking about this a lot and may actually be coming out with a white paper on it shortly. In energy in particular, because it's been so far off the run, and especially in energy small caps, there's a huge variance in valuation between some of the names and others. And there's a huge compounded return difference between some of the companies in the energy indexes and others. And so what that's led to is a period where even though the stock market's up a lot, energy stocks are down depending on the specific ones, and the small cap energy index, this S&P 600 index, which has an ETF attached to it, and I think is a fairly reasonable construction. It's less low quality than like some of the Russell microcaps or whatever, is down close to 70% over the last decade. And we're up quite a bit. You know, offhand, don't remember the exact number, but maybe mirror that, up 70, whatever, something like that. And the difference, as far as I can tell, is almost purely driven by owning companies at much lower valuations that have some sort of catalyst for revaluation, along with avoiding most but not all of the bankruptcies that happened to the energy companies in that S&P 600 over the course of the last decade, as there have been multiple sort of re-ratings down and then some re-ratings higher.
Yeah, it's active versus passive management question. That passive management, if you want to call it, that's not even management. Algorithmically determined fund flows is probably a better way to put it. Has had its day for almost 2 decades now, and the tide seems to be turning when you look at some of the margins from the large tech companies. They were able to kind of piggyback on the existing telecom infrastructure with the rollout of the internet, the mobile phone, the iPhone, and all that sort of stuff. But now the shoe seems to have dropped on the other side of the equation, which is their capex is really ramping up for all the data center type activities that we mentioned. And everyone's trying to win the AI race. In past, I guess, inflationary cycles, or maybe even a normal macroeconomic cycle, energy's represented a lot more than 3% of the S&P, right? So where do you think the median representation of energy in the S&P lies? I think the record in the 70s was like 30%. And I'm not suggesting we're going to get back to those levels, but where do you think a normal quote unquote representation might lie?
I think so. First of all, with that, I think there's a question of, is this full energy, or is it just oil and gas? Because oil and gas historically was such a big component of that. And now you have all these other companies, some of these like SMR companies that have $20 billion and no revenue, and other questions. But if we have similar composition to what we had, let's say in the 70s, yeah, I think the right number is probably in that sort of 10 to 12% of the overall market. The argument for lower is that the returns for the tech companies, like you mentioned, have been higher. But the argument in favor is those returns in some cases were driven, like you said, on prior investments that were sort of written down and that these companies were able to then capitalize on. In addition, there have been sort of unusual business circumstances where there have been sort of structurally higher or cyclically, depending on your perspective, higher margins for these sort of largest businesses. In some cases, it's been through monopoly protections where the companies have had patents and other things that have sort of forced them into a position of limited competition, or where they behaved in monopolistic ways, like, the Microsofts of the world, where they, got sued for monopolistic practices and then they supposedly lost, but here we are all stuck using the Microsoft stuff for higher and higher prices, and they just raised their prices supposedly 30% or something year over year. So, I think those things are probably from a long-term perspective temporary. There was trust busting that happened at various points in the US and elsewhere, over multiple different periods over the last, let's say, 100 plus years. So anyway, long way of saying 10 to 12 is probably reasonable. I wouldn't give up on it going a lot higher for periods of time. I think right now, with the way things are going, if you take your oil and gas investor hat off and you put your commodity investor hat on, oil, and to a lesser extent natural gas, has experienced radical underinvestment for exploration and delineation, and way too much investment on development of already found fields that are being exploited and re-exploited. And all those whole shale boom has been essentially just this optimization exercise on known discovered fields. And so from a commodity investor perspective, you look at that and you say, hey, that's the setup for an amazing bull market, right? If it were gold, we'd be back at $500 gold, and I'd have my, gold hat on saying, hey, it's going to 3,500. And people say you're an idiot. And then here it is almost 4,000. So I think when you think about it less as the thing and more about the thing in the context of commodity, rather than just the very politically charged and very sort of emotional topic of oil prices, I think there's a lot of room for prices to go up a lot, which would probably hurt some of the valuations in other sectors, and also force, so both through declines in other sectors and through appreciation, both multiple expansion and a higher commodity price that's received by these companies, as well as more profits for their service providers. I think there's a world where you see that, definitely multiple scenarios where that sort of thing happens. And that would be an argument for getting back to maybe not 30%, but maybe 15 or 20 or something percent of the market, in a scenario where you have another energy crisis that's maybe more persistent than the one we experienced in 2022.
And you mentioned the commodity super cycle. Everyone's been watching the gold price action over the last year and a half. Is there a world in which the gold price rises and the oil and gas, even throw coal into the mixed price, does not rise? Does that make any sense?
Yeah, there have been a couple. I was looking back at sort of this history. Obviously, gold has a much, much longer history than oil from a commercial price perspective, but especially as a global commodity. But when you look back, there have been a couple of times, I'm forgetting exactly when, where you've had gold go up and oil hasn't, or oil has even gone down. But most of the time when you have gold go up, with some lag, you have oil go up, both because of generally gold's going up due to regulatory issues and monetary, sort of this combination of really fiscal and monetary and some other change. And that's generally been a good, for the most part, setup for oil prices to rise a lot too. And the way it's mostly worked, again, not perfect. And, just because it's happened before most of the time doesn't mean it will happen this time. But the way it's worked is basically you end up with oil tracking gold's move, maybe a little more extreme, typically 12 to 18 months later. And we saw that. I told people that in early 21, telling them why they should be buying oil stocks then. and got laughed out of the room. Oh no, you don't understand. The pandemic's going to go on forever, but gold is great, and there's this inflation that's probably coming, so they'll buy gold and not oil. And at that time, when gold was pretty popular in that sort of 2020, both as a sort of place to hide in and for safety, and as an inflation bet, because everyone saw all of the stimulus, the monetary and fiscal stimulus going on at the time. And the right bet was actually to bet on oil, which you could buy in January of 21 for what, $40-$45 a barrel, and within 18 months it got to close to 100. And so I think the point where you really want to own oil and gas and related equities is where everyone's real excited about gold and seeing the gold price up a lot and the gold miners up a lot, and not really seeing it in oil or the oil producers yet. So I think right now is probably a great time to be talking about it. I'm not calling for a top in gold. Who knows where it goes? I hope it goes up a lot more because it's good for oil demand and it gives me even more upside for my oil price scenario. But that's how I think about it. And that's I just get excited. I bought some gold coins and bars and stuff when the price was a lot lower, and ended up like chatting with a Bloomberg reporter about it. They were like trying to write about Costco and how Costco was selling these things. And I'm a deep value guy, so I got 4% back on those purchases. So I bought them below spot, like around $2,000 an ounce. So I'm excited about those. And just for everyone, I got asked this a bunch on Twitter, X. They're in a safe deposit box. Like, sorry, don't get too excited. You don't want to brag about these things.
Qualify that. You don't want people coming to visit you at midnight.
Absolutely. So yeah, sorry, no assets on my person. But yeah, anyway, I'm excited about this commodity bull market, but I think there is a chance that this time is different. There's always that chance, but it looks a lot like early 21 in a lot of respects, even in terms of what's happening with Russia, which was part of the kickoff for that much higher oil price change from 2021 to 2022 with Ukraine bombing these Russian oil facilities and stuff. I'm not betting on that. I don't need that, I think, for this long run cycle in oil to work. But hey, I mean, physical supply disruptions definitely have helped in the past in oil bull markets to push prices way higher.
Yeah, certainly. And when you've got such a sharp, rapid rise in the gold metal price itself, all the guys that dig gold out of the ground, the producers, well, they tend to require a lot of hydrocarbon product, right? It's like the main input costs to their business. Now, let's talk demand and supply in oil and gas, particularly in the US, where I'm most interested. You put a tweet out just before with some commentary around the estimates of drilling production numbers inside the US. Can you elaborate on what the number was and what your take on that number was?
So can you clarify which post was that?
I'm talking about the US Department of Energy. America's producing more oil than ever before, hitting 13.6 million barrels of oil per day in June, more than any other nation. Drill, baby, drill was the tweet. And your comment was, does anyone believe this?
Yeah. So, okay. So I'm not saying that their production number they cited is wrong. We may be producing 13.6 million barrels a day. I've actually seen a couple of folks doing the analysis claiming that we're producing more than that. Seems unlikely, but possible. What I'm pushing back on is that the active drilling rig count is down about 25% or so from when Trump came into office. And
that
so,
was my question.
yeah, so there was this promise essentially to US consumers and to the oil and gas industry to get all of these inactive drilling rigs running again in the US. And so far, through a combination of very weird foreign policy where we've waived sanctions we've punished our allies through very significant tariffs, and then we've waived sanctions on our enemies. In some cases that we've even directly bombed, we're actively not enforcing sanctions on oil in particular, but on almost everything else, we are enforcing those sanctions. And so it's a very weird sort of combination policy that's essentially forcing the drilling rig count down in the US. So it's drill, baby, drill outside the US, or America last, I don't know, something along those lines, just for energy, which is the opposite of sort of what this claim is and what the policy is. And it's so weird because it's almost like they expect people to buy what essentially was a lie in a campaign promise 6 months later, 8 months later, after or longer, after they've already shown that they were lying and the data is the opposite of what they're saying. And so it's just sort of this weird, like, why keep, we already know they lied. Why repeat it over again now that there's 9 months of data or whatever where you can see that the chart is down? So I don't know, very, very strange to me. So I thought I've had fun sort of responding to their Twitter. I don't think anyone reads that from that,
Well,
from
I
the,
clearly did. So someone's reading it. No, I thought it
from the
was
Department of
interesting.
Energy.
Yeah, maybe less so. So is it fair to say you're not really buying the three arrows plan where you've got your 3% growth and reduction to 3% debt to GDP, and then the big one as far as our topic today, 3 million barrels of oil growth? Is it possible the US can do 3 million barrels worth of oil increased production?
Well, in some of those interviews they did early on when they introduced that plan, they talked about barrels of oil equivalent. And so that I believe, because we need something like 20 billion cubic feet a day incremental of natural gas over the next 4 years. And so that works out to be over 3 million barrels of oil equivalent. And actually, it works out well on the current trajectory. If we keep adding natural gas rigs and keep dropping oil rigs, we're on track to drop the oil by, let's say, 1 million barrels a day and to increase the gas by, let's say, 4 million BOEs a day. And so they'll hit their 3 million BOEs a day. They'll just have much higher oil prices and, have sort of shown that this whole drill baby drill for oil thing they were saying was just not something that was really in their plan, or that they thought they could just say and get people to do, while acting very much against it in the biggest ways possible, which is, going and forcing our friends and enemies to essentially produce as much oil as possible, and then rewarding our enemies by making them some of the very few countries that aren't being severely punished in US trade policy via, not enforcing sanctions.
Okay, thank you for clearing that all important point up around the BOE versus barrels of oil, because I think that certainly gets lost. Talk to me about the current state of the oil rig count, and you already mentioned the natural gas rig count, and the relationship between the number of rigs and then the pricing coming out, let's call it 6, 12, 18 months post. Like how quickly can we have an adjustment in the rig count in response to a presumed?
Yeah, so I think there's there is a lag. So the let's see, the oil rig count is down. I think the chart I had posted was for Permian. Oh no, I think that's for oil rigs. So we're close to, it looks like, about 530 oil and gas rigs. It looks like a little over 400 oil rigs, and it looks like a little over 100 gas rigs. And that's fallen pretty considerably. The oil rig count is down, it looks like, close to 50 or so since earlier this year. And I have to go through to see exactly, I probably should have pulled this up. The directional nature of this to me matters more than the precise number of rigs. And there was a report, actually, as we're talking today, earlier today, there was a report where it showed that the oil rig count for last week was actually up 6 and the gas rig count was down 1, which would be sort of the equivalent of like a counter trend rally. There's just, sometimes there's noise in the data, or there's a few more rigs that get added, and then you'll see like 4 rigs drop next week or something. It's not like they're actually standing up 6 more rigs and then as a new decision and then dropping 4 more next week. It's just there's noise in the data. So the lag between drilling rigs active, like change in rig activity, and then production typically is in between 6 and 12 months. And it's, that part also is a little counterintuitive. You'd think, hey, I drop a rig and production starts to get affected within a month or so, but there tends to be inertia on these things where, drilling a set of wells now might, you might, even with, let's say, one rig, drill 6 months worth of wells and then go complete them, and then you'll start having production on from those wells, let's say 8 months from now. Or another rig, maybe it's running and it drills wells for 2 months and then you complete those, and that might come on, let's say 3 or 4 months from now. Or in extreme cases, you might use that rig and not complete anything for a year and then complete them, and then production comes on. So there tends to be a lag, and sometimes it takes a little longer than you'd think, especially in either new areas or areas where there's midstream constraints. You have to build a lot of stuff from a gathering and processing and transport and so on perspective to be able to get production actually up and running. So there does tend to be a lag. It's sort of the joke among, I guess, it's a little like monetary policy where it's like a long and variable lag. So trying to apply too much math to that often just gets people to be precisely wrong.
But in the context of historic context, where are we in terms of the rig count? Is it historically low? We're in the middle. I'm guessing it's not particularly high. Just for someone who doesn't follow this necessarily, where would you rank the rig count at the moment compared to where it would normally be?
So relative to the oil price, the rig count is actually pretty low. If you don't inflation adjust it, you would, the bottom that oil rigs got to after the oil price crashed from having been at over 100 pretty consistently for many years to the lowest point it got where oil crashed down, I think below 30 in late 2014, early 2015, and then just crashed again and again into the bottom in early 2016. We're actually very close to that rig count right now, in sort of the biggest crash that we had seen up until that point in decades, even more than during the financial crisis in 2008. And then the only other crash that was sort of more precipitous was the crash during COVID, where oil prices went negative because the world shut down. So other than those two, what we've seen this year has been up there, which is again sort of amazing. And then the number of rigs running is close to the bottom that we saw, not for COVID. There, the rig count fell even more, but close to the bottom of what we saw in that giant sort of generational oil price crash from 2014 to 2016. And so the pushback that you'll get is oil rigs are way more efficient. You can drill more feet. Therefore, this doesn't count. And that's been true to some extent. But what we're seeing is that as the per foot well productivity across the US has been falling, that rig count is about to slingshot from being something that matters very little and where you're able to accomplish a lot with very few rigs to potentially being able to accomplish a lot less from a production perspective with a lot more rigs. And again, when you take the sort of combative oil investor, oil market analyst hat off and put the commodity investor hat on, this stuff makes a lot more sense. You start looking at sort of a longer term perspective and look at other timeframes when there were similar productivity improvements for periods of time and then productivity declines. And it looks like the most similar, I think, to the sort of 1960s and 70s period, where you had had this tremendous improvement in rig productivity and production per active rig and so on in the 60s. And as that peaked out after the second derivative started to fall, which is sort of, I think we've already seen that now in shale, where the rigs are still getting a little faster, but the production per foot is falling pretty rapidly. Once you get past a certain level, you start to add more rigs, but not necessarily get a lot more production or even any more production. And so we already saw this. That was part of what drove the oil price movements in the 1970s, where you had more and more rigs coming on. But I think you actually saw production decline for periods in the 1970s, even with many more rigs added. And so I think it's a thing. I think people have gotten too comfortable with ignoring the rig count, or even just this like sort of idea that rigs, you can do so much with so few rigs. And I think they're sort of ignoring the immense productivity gains we saw and the big problem of declining productivity per foot, both for oil and natural gas.
Yeah, what you're mentioning was well illustrated by a commentary from Goering and Rosenzweig. They went through the numbers of that period that you're mentioning, where it was a battle against geology. Like the technology of the time was maxed out, and there was just an enormous number of rigs thrown at the problem, so to speak. But unfortunately, it did not immediately, or it took a long time to increase production. There was definitely a disconnect there. With that being said, is that bullish mainly for oil services, onshore oil service companies in an environment like that?
I mean, it's bullish for almost everything except for the producers who have to go drill more wells and get less oil. And even those producers may actually make way more profit because a much higher price makes up for a lot of that from a financial perspective for those companies. So yeah, I think the biggest winners probably are the onshore drilling rigs, along with offshore rigs and wherever else you're going to go to try to get more oil. Service rigs should do well, pressure pumping should do well, sort of that whole oil field services complex should do well. I happen to like the onshore land rigs because people particularly dislike them, but there's way fewer barriers to get them to working again. A stacked rig versus a stacked offshore drill ship, where painfully people have discovered that it takes an enormous amount of capital and time in order to get things working again. And then the capital requirements for the producers or exploration companies that are going and hiring these offshore rigs are so extreme that there's real big barriers to increased activity. Whereas, and there's been increases in activity offshore, just maybe not as much as people were hoping. Whereas onshore, the capital requirement for getting a rig active for a period of time is actually relatively small, depending on where you are and what exactly you're drilling for. So yeah, I think my preference here, given the ultra low valuations on the land drilling side and just the hatred or, people just not even caring or thinking about these companies, has me loving them at very low cash flow multiples and huge discounts to replacement cost.
Okay. And is there any names that you want to give a general overview of in that particular sector?
Sure. Yeah, I'll share one. So I wrote about it for the Substack. I'll leave out a little bit of stuff. Like, I think it makes sense for people to go check it out. It's sort of it's a fun adventure in this newsletter world that I'm engaging in. So the high level thesis on Ensign drilling, which I had talked about before I launched the newsletter, and that's sort of a logic in sharing it here as well, is that you have two famous billionaires who are backing this basically publicly traded LBO of a drilling rig company that's done many acquisitions since it started, mostly debt financed. And the one who matters, I think, from an operational perspective is Murray Edwards, who is famous for his tremendous success with Canadian natural resources, a multi-tens of billions of dollar Canadian oil and gas company that's done phenomenally well, mostly to Murray Edwards' credit, as well as to the people who he's brought in and managed and grown. Phenomenal oil and gas entrepreneur and success story. And this is his drilling rig company. And people talk about Canadian natural resources till they're blue in the face, and they never talk about Ensign drilling when it's an LBO that he owns something like 30% of, that he just put money into via small amount of convertible debt. Weirdly, the market didn't like that he and Fairfax Holdings, this Canadian Berkshire Hathaway, essentially, that's done better than Berkshire for the last 30 years and is a brilliant investment firm that's done tremendously well. They both, along with the management of Ensign, funded a $25 million convertible debt deal at the end of last year, just as a part of a debt repayment plan. Ensign's been paying off $200 million of debt a year, and they were 25 million short on repaying the bank debt. So these guys wrote a check, which is amazing. That should have been, the stock should have gone up, in my opinion. Don't rely on this, whatever, $3 a share or something on Prem Watsa and Murray Edwards writing a $25 million check, right? Like, that tells you they're backing it, right? And again, no one knows the future, but they're not doing that with the plan to then abandon it and lose their money. And so you have this thing where, a few hundred million market cap, $1 billion of debt, $5 to $7 billion of replacement cost of rigs, and everyone loving the people involved, but not even knowing that this thing is there. So it's one of my favorite ways to play it because there's just so much potential upside. And I think on its own, it would be fine, right? The company has paid off close to $600 million of debt in the last few years just from its own sort of organic free cash flow. It's at a point where people really shouldn't be worried, I think, that much about the remaining debt, given how fast they were able to pay off the debt, and where it's very well positioned cyclically to be able to take advantage as we eventually get into an upcycle for drilling. And in an upcycle for drilling, they would be one of the biggest beneficiaries, having sort of one of the biggest fleets of unutilized rigs that are ready to go to go drill with. The one other aspect of it that I think people don't really appreciate is in some of the markets they're active in, they have the best rigs. So in the US, for example, they're a top 5 drilling rig operator, and their rigs are almost indistinguishable from H&P or Patterson or Precision. Like they have some of the best rigs in the Permian and elsewhere. They're up there with everyone else. In other geographies, they have chosen to underinvest in their fleet because the returns on that capital deployed would be insufficient. And so I think when you look at an operator like that, it's just so important that they are careful with capital deployment and choosing to reinvest in rigs, which some of their competitors have done, versus choosing to pay off debt and be well positioned for the next cycle. It's a very sort of interesting, nuanced choice that you would not expect from just someone that, reads the book on, hey, how do you run a drilling rig company? What do you do? But it's definitely what you would expect from multiple billionaires who made their money not from luck, but from very careful capital allocation over decades. And so they're showing what you would expect for that. And to me, that's just so exciting to get to own that as a LBO, right? Like there's so much potential upside from that sort of financial engineering. And, the biggest risk is always, hey, what happens in a downturn? And again, there's not perfect insurance on this, but these guys with more money than maybe even things to do with it just wrote checks, and the company has paid off another 100-something million of debt since then. So, they're really showing a good ability to pay off debt. And the one other thing that's worth noting is that a few years ago, Ensign had to refinance I forget if it was just a high yield or a convert or something. They had debt that was due, and it looks like there was substantial positive intervention by one or two of their largest shareholders, where the consensus estimate we had from talking to analysts, sell side research analysts and various other folks, and talking to some mezz bankers that could sort of give us an estimate on what, without names, like what this sort of thing would cost, was that it would be a mid-teens interest rate, let's say 15%, 17%. They'd be able to borrow it, but it would be that rate. And my guess is that it started with, then getting a term sheet for a mid-teens rate. And I won't say which of the two billionaires, but one of them, I imagine, calls up his contact at XYZ big Canadian bank and says, hey, they're like, sir, how can we help you? And it's like, well, this is not an acceptable rate. What can you do
can
for
knock
me?
a few points off the quote for me. Thanks.
Yeah. So I think, it's possible that he knocked the interest rate down by 50% or 40% or something. They got a sub 10% rate on that second lien debt, when the market was probably like mid to high teens. So again, will it happen again? I don't know. There's no guarantees that things will repeat, but it's really helpful to study the past to see what might happen and to understand sort of the backing. And again, I'm not suggesting this was cavalier, right? Subsequent to that, there's been hundreds of millions of dollars of debt amortization by Ensign to the lending group that did this loan. So it was a good credit. And the two billionaires involved have written checks since then to help support it, small checks, but it can really help to have that sort of support to be able to, be that much more successful in a scenario where you're cheap on cash flow, cheap on replacement cost, and extremely financially levered.
Yeah, plus the all-important aspect that Uncle Rick likes to talk about, which is adult supervision in management. So where do you see, if we zoom out upstream and midstream, how do you see midstream in particular? Because I see some midstream opportunities that look to me to be relatively cheap. I think midstream kind of gets slept on by the rest of the market. Does midstream have any place in a Bison portfolio?
Yeah, so I used to own a few different times. I used to own this company called Crestwood, and it was a battleground stock, which should not be too surprising to anyone that's followed sort of the stuff that I've done. And basically, it was actually not that different from Ensign in terms of having backing from, it was backed by a giant private equity fund that had put in money several different times and facilitated transactions. It was a very well-known firm. And basically, every time that Crestwood either cut their dividend or everyone was worried about them cutting their dividend or distribution and the unit price collapsed, I would go buy a bunch. And so I can't remember if I owned it 2 or 3 times, but basically, it was probably a top 5 return for me ever in terms of rate of return and total ROI. And again, I'm not saying that I'm perfect. I've made lots of mistakes and lots of whatever, but it turns out that I'm a really good sniper at midstream, which is when you find a company that has a good backer and everyone gets worried about the distributions because there's a crash or whatever, or some other issue, that I was able to look through on this one and a couple others where it was just pretty clear that there was a market for these assets at a way higher price than where it was trading. And it was, but so the long answer is yes, or short answer to that long, I like midstream a lot, but I like to buy it at a huge discount in order to earn a really good return, because there's lots of risk and uncertainties in midstream, just like in anything else. And I prefer for those risks to be feared and way closer to being realized, but priced in way, way, way more than the actual risk, versus when people are looking at these things, oh, is it a 7% yield or a 5% yield? And maybe it'll go to a 4. That sort of game to me is way less interesting. And so it's meant I've missed some very nice compounding opportunities in some of these very high quality midstream companies. But, my preference is just not to play that game, because I've seen some of them that people really loved just completely collapse for various reasons, even after they were considered sort of the best of the best. So think of like a Kinder Morgan, where, even after oil crashed, it still was at 40 or 45 or whatever. And then, people started to get worried, and it went, I think, from 40 something to 15 or something like that in 2015, 2016. So I think of that every time I'm about to go buy a really well-run midstream company at a small discount.
Yeah, I know a lot of people that have PTSD from about 10 years ago in the midstream space. It seems to be turning around. Seems to be some opportunities there. Last topic, I can't let you go without discussing a few of my favorite royalty names with you, Josh. I'm looking at Viper Energy and its recent deal with Cidio Royalties and its special relationship that it has with its sister company, Diamondback. And I don't think the market's really valuing the assets on hand. How do you see a company, we can talk about Viper specifically, or generally the landowners with royalty rights? How do you see that sector of the market generally today?
So this area of the market, I think, is probably one of the biggest disconnects between the value of a small asset in a private deal and the value of these companies as public equities or public units or whatever. And so my bias on them is very negative, because for the most part, they trade at a large premium to what I could just go buy if I went on, Energy Net or some sort of similar auction house thing and just bought a single mineral acre that I could underwrite and know exactly what's happening on it, or it's already producing or whatever. And so generally these things, I guess because people aren't that familiar with it and would be scared about their own underwriting of these sorts of opportunities, generally they trade at really high valuations relative. I don't know about replacement costs, because I don't know how you put together the 500,000 acres or something these guys have. You
Correct. I
can't
think
do
that would
that.
be the point.
Yeah, it'd be impossible, but I don't need to do that, because I also don't have the 40 billion or 30 billion or wherever their combined market cap is. So that's not a problem I need to solve. All I need to solve is, hey, could I go buy, if I wanted that exposure, could I go buy $1 million of royalties either in the Permian or in a similar setup, and buy it at a very large discount to where they trade? And the answer is yes. And why that matters so much for this sort of asset class versus operated oil and gas or midstream is, if I want $1 million of pipeline exposure, that is extraordinarily difficult to create in the private market. Like you just basically can't do it for the most part. If I want $1 million of mineral exposure, I have 3 friends I can call and I can have it tomorrow, plus or minus a little signing, wiring, whatever, but that's it. So again, I'm pretty biased against that. I also see it as sort of an extreme case, similar to that sort of Kinder Morgan example. And Kinder Morgan is a great company with great assets and huge cash flows and all kinds of wonderful things that were dynamic and that were persistent through a terrible oil bear market. It didn't matter because they traded at such a high valuation in 2014 and into 2015, their stock price still fell dramatically. And so when I have this combination of relatively high valuation in my assessment versus the cash that's generated by the company at the time I'm looking at it, as well as a reasonable expectation of that cash flow over the near to medium term versus the ability to go get that cash flow, especially in this case, in the private market at a giant discount. There's no world where I'd go and buy either of those stocks.
Okay. My thoughts on that would be, well, why hasn't a group of lads got together and made almost like a SPAC and tried to do that? If there is this arbitrage between the private acreage available, why hasn't someone formed some sort of SPAC, acquired this acreage privately, and then listed it as a new public entity to take advantage of the arbitrage that you mentioned?
Maybe I should do it. I mean, people do that to some extent. There have been very, very weird transactions that I don't want to call out by name, but various companies have done stuff like that where they've done related party transactions where they basically, some of these existing public companies will end up going and paying a really high price to buy a relatively small number of acres of minerals or whatever. So you do sort of see that. It's just so much easier to do it with one of these big public companies. If your question for me is, hey, Josh, why aren't you just going and doing that? I sort of am. And like, I'll keep you, there's, I'm not on the mineral side exactly, but there's a similar line of business that I found and it's great. And so there are opportunities like that. And I'm not doing it right now in the minerals because the payback period right now on private minerals, on these public things, your payback period is forever, right? It'll take, if you're getting a 3% yield, what's that take? 30 years plus to, get your money back just via cash flow. The payback period on these mineral deals on the private side, typically let's say that you could create one of these things at a fifth of that. So you're still talking about a payback period of 8 years or something like that on minerals. If you get a good mineral deal, maybe it's less, but there's more risk or whatever. The payback period on some of this other stuff I'm looking at is way, way faster, but similar sort of potential uplift. So, on the private side, I'm very much a cash on cash guy. And so I sort of don't care to some extent if, I could go buy something with an 8-year payback and sell it to someone for a 24-year payback. That's nice, but I'd rather go buy something with a 18-month payback and maybe just hold it and generate a bunch of cash flow, or, turn around and sell it for a big uplift after buying enough of it. So anyway, people are doing that. Mostly they're doing it via these large public companies that already have these high valuations. And actually in 1 or 2 cases, people are doing that the other way around, where there was this one PHX Minerals that was trading at a very low value, but it was also not very well run. And an activist came in who actually has a private mineral company and essentially forced them into a sale at a high price relative to where it was trading, but a low price relative to what it would have cost to go and buy those minerals in the private market, and a very low price versus where some of these other larger publics were trading. So anyway, there's arbitrage going on in both directions for that. There's lots and lots of opportunities, but there's also a whole world of people doing that. So it's very, especially on the mineral side, it's very, very competitive. But I would expect, actually wasn't one of the companies I think that Sitio bought was a SPAC that had done that, and then they ended up buying them when the price was depressed during COVID. And then so you're actually getting a SPAC as a part of that that royalty deal.
Yeah, and they themselves were an acquirer, so it's like an acquirer got acquired by an acquirer who got acquired by an acquirer.
Yeah, but it's not so bad. Just to clarify for everyone, look, like, one, I think these companies are wonderful, which is why they trade at such high valuations. And 2, unlike SPACs in general, let's say business services or various other things, I actually think a SPAC for minerals is pretty promising because you're not dependent on the operations of the SPAC or that business. You're just buying a royalty that typically, some big company or set of companies are paying from their operations. And so I think like the intrinsic risk from an operations perspective is quite low. It's more just a question of what valuation are you paying and sort of what other fees and promotes and other stuff are there on the.
Okay. Well, if you ever do want to start to roll up some land out there in Texas and start a SPAC, I expect a DM. Josh, a pleasure as always. Where can people learn more about you, Bison interests, and the wonderful research that you put out, now available on Substack?
Yeah, sure. Okay. So thank you so much for having me. I love watching your progression, seeing all these different great people come on your podcast. So it's fun to get to be on this. Thank you. I have two separate things that are not at all related. One is an investment firm called Bison Interests, which I co-founded a decade ago. I manage, and we invest in publicly traded oil and gas companies. And then separately, I formed a media company called Bison Insights, which has a newsletter that's published on Substack. And if people go to bisoninsights.info, which was sort of a fun, I learned there's this .info option, they can find it. And it turns out that it's actually quite helpful from a compliance perspective to have just sort of, instead of throwing out stock names on Twitter or wherever, to sort of have an organized way with very clear disclosure and clear rules and all that stuff. And it's nice because we're having a third kid at the end of October. And the joke is that the newsletter subscriptions, it's the daycare fund, which is wildly expensive here in the US. So now we'll need daycare for 3, which it looks like the newsletter should be able to fund.
Excellent. Well, I'm very pleased to hear that, guys. Links to all the aforementioned places will be left in the description. Thank you once again for joining us on the ROI channel, and I look forward to catching up with you in another episode shortly.